The U.S. economy may be facing another recession, and the Federal Reserve seems powerless to stop it. In his recent testimony before Congress, Fed Chairman Ben Bernanke was surprisingly forthright about the challenges facing the economy, in particular the real estate and job markets.
The housing market remains weak, with the overhang of vacant or foreclosed houses weighing on home prices and construction. An important drag on household spending is the slow recovery in the labor market and the attendant uncertainty about job prospects.
When the country's top central banker puts aside his rose-colored glasses and speaks so candidly, you know we're in trouble. This week, we'll examine the state of the U.S. economy with a roundtable of experts, including Connecticut Senate candidate Peter Schiff. What does he want to hear from Ben Bernanke and President Obama, and what are his solutions to our economic challenges? We'll break down the policy responses available to the Fed and discuss whether any of those options will actually help. And we'll tell you how you can protect yourself from the coming downturn with recommendations from Weiss Capital Management and Weiss Ratings. All of that in a special commentary from Martin Weiss right now on Money and Markets.
From our studios in Jupiter, Florida, Weiss Money Network presents Money and Markets. And now, Jamie Holmes.
Hello, everyone. This week on Money and Markets, we revisit a topic of vital importance to every American and the rest of the world, the U.S. economy. Are we headed into a double-dip recession, and how can the Federal Reserve attack that problem? Joining us to discuss those questions and give you some ideas about how to protect your money is a special roundtable of guests. From Weiss Research, debt and interest rate expert Mike Larson, Mike Burnick, the Director of Research and Client Communications at Weiss Capital Management, and Peter Schiff, President and Chief Global Strategist of Euro-Pacific Capital and a Republican Senate candidate from the great state of Connecticut. Mike Larson, we're going to start with you. What are you seeing since we last spoke about the economy now?
Sure. I think the U.S. economy is really in a lousy state here. Virtually every report we've seen recently is negative. You have durable goods that just had the biggest decline since last August. You have consumer confidence that's down some 20% in the last few months. You have new home sales that just registered their worst reading in 47 years of government tracking. Essentially, all segments of the economy are decelerating, and I believe we're probably heading into a double-dip recession based on some leading indicators and what we've seen and what we've heard as well out of some of the CEOs. Companies like Whirlpool, the home builders, and so on, they're not seeing any more demand. Once the tax credit expired, that's sort of fallen off a cliff. And lastly, there's credit growth. There just isn't any. If you look at the major reports from the banks, the JP Morgans, the Wells Fargos of the world, they're not lending. They're just taking that money and sitting on it. So when you don't have that raw fuel for the economy, you're not going to have growth.
Okay, Mike Burnick, you agree we're headed to a double-dip recession?
Yeah, Jamie, I think we could already be in one right now. If you look at the growth rate in the leading economic indicators, we're at a negative 10.5% right now. Now, 6 of the last 6 times we've been that low or lower, we've either already been in recession or headed into one very quickly. So, at Weiss Capital Management, we've been in the deflationary camp for some time. We've been expecting another pullback in the economy, and I think it's here now. Whatever growth we did get in the last few quarters, as Mike pointed out, was really just artificially stimulated. Government stimulus spending,
the buy and pay
low
for
interest
recovery.
rates. Exactly. It was, the tax credits. I mean, those are just gimmicks. If you look at real final sales in the economy, they're inching ahead about 1.2% over the last 4 quarters, 12 months of virtually no growth at all, or very anemic. So I wouldn't be surprised if we don't see a double dip here either later this year or early into 2011.
Okay, Peter Schiff, you warned about the last financial crisis as early as 2004. Are you seeing similar warning signs from this economy?
Yeah, I don't think we're headed for a double dip. I think we're already in what will eventually be called another depression. The difference is this one will be an inflationary depression, making it much more painful for most people than what happened in the 1930s. See, we have real structural imbalances in this economy that was caused by previous rounds of government stimulus, and these new doses are preventing the economy from restructuring in a positive way. That structuring will involve some short-term pain and a recession, but trying to avoid the pain, that's what the government ends up turning a recession into a depression, and because they're printing so much money to try to artificially stimulate the economy, they'll turn it into an inflationary depression that will destroy the value of our money, that will make this predicament that much worse.
Okay, Mike Larson, let's talk a little bit about the economy and where we are with the Federal Reserve's response to it. Sure. Listen to what Ben Bernanke said about the interest rates in his recent testimony before Congress.
The FOMC continues to anticipate that economic conditions, including low rates of resource utilization, subdued inflation trends, and stable inflation expectations are likely to warrant exceptionally low levels of the federal funds rate for an extended period.
Okay, Mike, we've got interest rates already at near zero. What's left for the feds to do here?
Well, sure. There's a couple of things that Mr. Bernanke's talked about doing, such as cutting the interest rate being paid on excess reserves that the banks park at the Fed. The idea is if we lower that to essentially 0%, banks will be more likely to make more loans. Or the Fed could fall back on what they call quantitative easing, which is just a fancy way of saying printing money. The problem is they've already tried that. We already had upwards of $2 trillion of newly created dollars, and what did we get out of it in terms of the real economy? I mean, the Fed can manage from time to inflate asset prices, but the problem is they're not creating jobs. The Fed can't magically create jobs by printing money. So what we're seeing now is an economy that's continuing to suffer, and going forward, really, as Peter pointed out, what we haven't done is cleaned out the excesses from the past bubbles that we had in tech stocks and housing. The Fed's just trying to paper over that problem. And as long as that's the case, really, investors aren't going to fall for it because they've been fooled before.
Okay, we have heard talks about another round of possible stimulus spending. Mike Burnick, is that a real possibility?
I don't think it's very possible at all. I mean, we have a very contentious election coming up for the midterms here in the fall, as Peter certainly can attest. I just don't think there's the political will for any kind of a massive stimulus package now, nor is it needed. I mean, it's just throwing good money after bad. You know, as Mike pointed out, we're not, sure that any of the last spending really went anywhere except down a black hole. So what's really the point? I think it's going to be very difficult, really, for the political will to get on board with anything. The biggest problem we have facing us is massive tax increases that are going to take effect in 2011. That's really what Congress should focus on. But in an election year, I don't see it.
Okay, Peter, is it safe to assume here you would vote against another stimulus package if you became a member of Congress?
I want to vote for real stimulus, which is shrinking government. That's the only way to stimulate the economy, is by getting government out of our way. Government is sedating the economy with regulations and spending. And you just mentioned the Fed. Low interest rates are not part of the problem. I mean, part of the solution. They're part of the problem. We need higher interest rates. We have to encourage savings in this country. No one's going to save with 0% interest rates. We can't have economic growth without savings. We can't have businesses. We can't produce goods and services. We can't provide employment without capital investment. And we're not going to have any of that with 0% interest rates. And we're not going to have any of that with the government running $1.5 trillion a year deficits. Everybody needs to stop spending, from individuals to the government, because that's the only way this economy can start growing.
Okay, let's play devil's advocate here. Mike Larson, there is some debate over whether the first stimulus package, that it wasn't big enough. Just for the sake of argument here, let's say the Democrats are going to push something through or can push something through. What kind of impact would that have on the economy? Well,
sure. First of all, I think that even if the political willpower was there, and I don't think it is, the bond market wouldn't allow them to. I think if you look at what happened in Greece, it's very instructive. They tried to spend their way out of these problems, and eventually it drove bond investors running for the hills. I think you would see something similar happen in the United States, where you'd have interest rates go up and bond buyers go on strike if all of a sudden you had this huge new stimulus. And on top of that, it's clear that the first round of stimulus didn't really work. What out there, if you're watching what happened, you look at these hundreds of billions and even trillions of dollars being spent. What did we get for it? We don't have anything to really point to tangible. And I think with that being the case, people are very afraid that we're going to end up with stimulus package after stimulus package and essentially become the United States of Japan.
Okay, Peter, if more spending is out of the question, then what would you suggest to Ben Bernanke and President Obama?
Well, for Ben Bernanke, he needs a spine. He needs to be an independent Fed chairman and do what Alan Greenspan wouldn't do, and that's raise interest rates and stop monetizing government debt. Let the government know that if they want to spend $4 trillion, they're going to have to raise it in taxes, which they can't do. So if we had some discipline out of the Fed, then government couldn't get away with all these deficits. And of course, what Obama needs to understand is how free markets work and how wealth is actually created. He wants jobs. Well, we need the free market to provide them. He wants credit. We need savings to make it possible. So the government has to get out of the way. We need less government, not more. We need fewer regulations, not more. It's government regulations that created the housing bubble. Government regulations and subsidies led to the financial crisis. These weren't things that happened in the free market. It wasn't a failure of the free market. It was a failure of government intervention into the free market, and that has to stop. And if he won't stop it on its own, if I can get to the United States Senate, and I'm in a difficult primary right now, just trying to win on August 10th. So hopefully if people can help me win the primary, I can go to Washington and explain these things, not only to Obama, but to the other 99 senators who are just as clueless.
Okay, Peter, if your policy prescriptions are followed, do you think the economy is going to turn around fairly quickly? Or is this just a case of we got to take our medicine here and we're going to face another recession regardless of whatever the government does?
Well, there's going to be a recession. The question is, do we want a depression? I don't. I'd rather take a sharp recession. I'd rather rip the Band-Aid off than peel it off slowly. We have dug ourselves into a gigantic ditch based on reckless monetary and fiscal policy. We got to climb our way out of it. This is going to be sacrificing for some people, but if we don't dig it, if we don't get out of it, if we keep digging, we're going to turn it into the Grand Canyon. And you know, for some people, just not shopping, it's not that big a deal. We have bought so much stuff. We don't have to keep buying. But people who are working in a service sector, working for government, working in the finance industry, a lot of them are going to have to get new jobs. We need productive jobs. You know, we don't want to work just for the work. We need the productivity. Remember, in the old Soviet Union, everybody had a job, but you couldn't buy anything with your paycheck because nobody made anything. And we are in danger of repeating all those mistakes. So we need to understand how economies grow, and we need to pursue policies that will enable that to happen.
Okay, Mike Burnick, how is Weiss Capital Management talking to its clients in order to protect themselves during these rough economic times?
Yeah, it's a great question. You know, it has been a very difficult, very tricky investment environment. We're basically telling our clients and reminding really all investors to keep three guidelines in mind. Number one, deflation is still the threat that's here with us today, but inflation is something we have to guard against in the very, very near future, as Peter pointed out. Now, that debate between inflation and deflation is causing a tremendous amount of volatility in the markets. Nobody's sure where we're headed next, double dip or not. You know, this time last year we were debating about the V-shaped recovery that everybody was hoping we'd see. Now we find that the V really just stands for volatility. We've seen incredible whipsaw trading in stocks and bonds and currency so far this year. You know, the European debt crisis came out of nowhere, left field. So, you know, these kind of periodic crises, these flare-ups of problems are just symptomatic of this deep hole that we've dug ourselves into. Not just the U.S., but really globally, all the major economies.
Mike Larson, very quickly, you agree with that strategy?
Yeah, I think you need to be selling down your stock exposure and get defensive. You need to be raising cash across the board. And you also need to be looking at ways to hedge against downside. I mean, it's easier than ever for investors to do that using things like put options or inverse ETFs. So I think that the individual investor really needs to prepare themselves for this economic storm.
Okay, Peter, in addition to being a candidate for Senate, of course, you're also the president of Euro-Pacific Capital. What is your strategy here for navigating this market?
Well, you have to be concerned with purchasing power, not simply the number of dollars you have. As I've said, I think we need deflation. It would be healthy, but we're not going to get it. We're going to get inflation and maybe runaway inflation. So you have to be concerned about the value of your dollars, not simply the quantity. So if you want to be defensive, I think you need to own precious metals. We've been buying gold and silver for over 10 years and other commodities, agriculture, natural resources. And we're doing a lot of things wrong, but other countries are doing a lot of things right. So you want to be exposed, I believe, to equities in the countries that are growing, that are saving, that are producing. We have a lot of exposure to the Asian economies, particularly in China, Singapore, Hong Kong, a lot of the natural resource sectors. I like the Australian market, the Norwegian market, Canada. We have money in Latin America. You got to focus on dividend yield. You know, when you own a stock, you want to make sure that the managers are working for you, not themselves, paying you dividends, not inflated salaries. So there is a lot of value around the world. I think the people who are trying to play it safe in dollars, in treasuries, in cash, in muni bonds, I think ultimately they've got the most to lose because they're going to be holding on to a currency that has very little purchasing power.
Okay, Peter, stick around. We're going to be talking to you a lot more in just a few minutes here about how you would want to change the country's economic policies if you were elected to the U.S. Senate. Mike Larson of Weiss Research, thank you so much for being here. Mike Burnick of Weiss Capital Management, thank you. And as always, we want to hear from you. If you have questions for any of this week's guests or suggestions about topics that you'd like us to cover, just email us at weissmoneynetwork@weissinc.com. Coming up next, our Picks and Pans segment focusing on one sector of the economy that could be in big trouble if another recession hits. And later, we're going to hear from Martin Weiss. Money and Markets will be right back.
America is in trouble. Federal and local governments owe over $123 trillion. New debt is escalating at the rate of $183 million per hour. That's $1.6 trillion per year. Bond prices are plunging, and that could drive interest rates sky high, triggering an even deeper recession. If you are worried, and you should be, download Mike Larson's blockbuster new report with urgent investment recommendations to help you protect your wealth and profit. Don't delay. Do it now.
With risks on the rise, you need investment advice you can trust now more than ever before to help protect your wealth. At Weiss Capital Management, we've been managing money professionally for over 20